Hello, and welcome to this week's edition of Watching the Tape. It's getting a little choppy out there in financial markets. As I record this video, the S&P 500 is down 17% year to date, while the technology-heavy NASDAQ is down 27% year to date. Stock market volatility is nothing new, and if you have a long investment horizon, then you can ride out the wild swings that inevitably happen from time to time with the knowledge and the comfort that holding stocks is a proven way to grow wealth and beat inflation in the long term. So here is a 20-year chart of the S&P 500, and it shows that corrections like the current one happen from time to time, every so often, but the general trend is still up and to the right. Now, having said all that, it's still no fun at all when you're in the middle of a correction like this. All right, so the topic for this week's video is a currency that is the nearest and dearest to our hearts. It's the US dollar. And ladies and gentlemen, we have a strong dollar on our hands. What is driving this and what does it mean? Well, first, how strong is it? And according to the dollar index I track, and this is an index that measures the US dollar against a basket of other major global currencies. The dollar is up 16% in the past year. Now, I kicked off this video highlighting the sell-off in stocks this year. And this is happening globally, not just in the US. And we call this a flight to safety or a flight to quality or simply risk off. So many investors throughout the world are moving capital out of risky investments like stocks and into safer assets. Well, the US dollar is the world's reserve currency, so it is a safe haven currency, and bonds act as a safe haven too, for if you're looking for a place to park money and it's a safer asset. And guess what? Interest rates in the US are far more attractive than in other developed economies. So the money is flowing here. And in order to gain access to those bonds in dollars, you have to first buy dollars. And it's this bid for dollars that is pushing up the value of the US dollar relative to global currencies. And there you have it. That is the ascent of the dollar. So what does this mean for you? Well, inflation is still running hot. April's data showed that prices increased 8.3% over last year's April. This is the 12th straight month of CPI inflation at 5% or higher. Now, keep in mind, our central bankers are targeting an inflation rate of about 2%. And here's where a strong dollar fits into that inflation equation. A strong dollar allows us, as Americans, to buy imported goods from other countries using fewer dollars, so at lower prices to us. So I like to think of it this way. If a new BMW is selling for 50,000 euros, my stronger dollar can buy more euros than it could previously, than it could last year, for instance. And so I can pay less in dollar terms for that new BMW. So the net impact of all this is at least a partial alleviation of the inflationary pressures that we're all experiencing. And that's good news. On the flip side, the products that are manufactured here in the US and sold overseas are less competitively priced in the global marketplace. So a stronger dollar is obviously harmful for exporters. Before I go, because inflation is running hot and it is a hot topic, I wanted to share a reminder that I put out a video in December about U.S. government inflation bonds or I bonds. And you can click on the link below to access that video if you like. Otherwise, please call me with any questions. If you can think of someone else who might enjoy any of these videos, please feel free to share. Thanks for watching. We'll see you next week.